We saw a brutal start to the markets yesterday with the indices falling as much as 2.5% on the day, but that is only half the story. While we have fresh earnings data from the retail sector, the market's attention has been hijacked by the US-Iran war, which has shocked markets around the world, including South Korea index, which closed minus 12% today. So in today's video, I'm going to talk about how geopolitical risk is affecting corporate earnings, as well as a quick company's earnings snapshot from yesterday. Now, if you saw your portfolio yesterday, you likely saw a sea of red. We saw the Dow Jones close down 400 points, and that is not a full story because the intraday volatility was significantly worse, with the Dow down over 1,200 points at the lows before stabilizing during the later part of the day. And we also saw this continuing towards future, as you can see over here right now, where futures are down close to 0.2 to 0.3%. And in Asia, where we saw the South Korea index closing at minus 12% today, which is the worst day as Iran conflict fuels risk-off sentiments. They even had their circuit breaker yesterday and today, which is implemented when the market is falling sharply. So what is driving this sudden shift in sentiments? It is not earnings, but it is the return of the geopolitical risk premium, specifically what we all know and what everyone is talking about now, the US-Iran conflict, where initially everyone thought that it would just be days, like what happened in Venezuela. But Trump has openly came out and said that the war could last weeks. And this is not good. Why? Because we also have Iran coming out to say that they are going to attack the Strait of Hormuz. Now, if you're wondering what is the Strait of Hormuz and how it affects global oil supply, I actually did a full video about this earlier, and I will link it in the description box down below if you want to watch it. So, but if this Strait of Hormuz actually close, it will not be good, in addition to the war prolonging. Why? Because it could push oil prices higher. And if oil prices goes higher, what is going to happen? Production costs will go up because oil is being used across every single thing in the world, right? Cars, commodities, every single thing requires oil to run, especially production costs, as we're talking about the AI build out right now, right? To run it, you definitely need oil. And supply chain is going to get tighter, right? Because oil supply will drop, oil prices will go up, and these will actually cause production costs to go up, and worse still, manufacturing delay, right? So this is what we can see might happen. And this is the risk we saw, which caused the South Korea index to drop more than 12% today. And we are seeing oil price actually creeping up higher than it was yesterday. Now, crude oil is at close to $77, and Brent crude oil is at $83 right now. Both of them at its 1-year all-time high. Now, why does this matter? Because oil is the one variable that the Federal Reserve cannot control. If energy prices spike, headline inflation will reignite. As you can see, this relationship between oil price and the US inflation rate. And we saw that in the markets, where the markets begin pricing out the probability of a near-term rate cut. Like we see the next Fed meeting coming out, the next 2 ones, the probability of a rate cut is actually close to 0. And bonds also sold off. So when yield rises on inflation fears, the valuations that we see in the tech sector, that is what is going to, what's happening now is all compressing, right? Investors are rotating aggressively out of this kind of growth sectors into more defensive assets like the US dollar, and to a lesser extent to gold as well. Now, amidst this macro chaos, we did actually see some divergence in corporate earnings, and it was a tale of two markets. We actually see efficient retail companies being rewarded, whereas certain tech stocks that are priced for perfection, they are being punished. So let's take a look at this. The first one is Target. So Target actually closed up nearly 7% yesterday. And on the surface, right, this makes little sense, right? You saw the revenue actually declining. You can see the revenue and the store traffic fell during its holiday quarters as company tries to end a sales slump. And this report is actually the first since the new CEO, Michael Fidelki, took over last month. But interestingly, what did we see the price react? It actually went up by close to 7% on that day as well. And you would think that in a market right now, a revenue miss is usually a death sentence, and Target has proved otherwise. Why? It's because we are in this, what we call profitability market, where the market wants to see profitability improving for every companies, especially now everyone is becoming more defensive. So Target actually reported their adjusted earnings per share of $2.44. Okay, completely crushing expectations of $2.16, right? So this is what they reported, which actually caused the market to price them up to actually cause this increase in share price, right? And how did they do it? It is through disciplined cost control and inventory management. And this is what the CEO also shared. They are trying to bring back what actually worked in the past, which is selling affordable, trendy fashion and furnishing that helped Target earn its own Taze reputation, right? And they are also going to add new buzzy brands that can win back shoppers. And they said that their plan is to get Target back to growth. So this gave a lot of confidence to the market about the business. Now, when we look at the next one, Best Buy, we also saw a similar story where the stock actually rallied 7% yesterday. And again, they missed Wall Street's revenue estimates, but they beat the earnings expectation, right? So this reinforced this narrative that we are seeing right now, where the markets are looking at profitability. Now, consumers are buying fewer electronics or maybe cheaper ones, but Best Buy has cut costs aggressively, and they are making money more even on lower volume, right? And this is what is happening now, right? The market is forward looking. Investors are buying Best Buy now to be positioned for that hardware replacement cycle later this year. Now, let's contrast that with the cybersecurity sector, specifically CrowdStrike that reported yesterday. So CrowdStrike actually reported a double beat, both on earnings and revenue, but the stock was actually muted. It didn't actually react much to the news. Even though we saw the annual recurring revenue hitting 5 billion, this was a huge milestone for them. And even the CEO, George Kurtz, actually addressed the AI cloud code security threat that came out. And he also quoted that their fiscal year 26 will go down as their best year yet. Now, I've already done a full earnings review on CrowdStrike earlier today, and I'll put the link in the description box down below if you want to watch it. And we also saw Sea Limited, the parent company of Southeast Asia e-commerce leader Shopee, reporting their earnings, and the stock closed down a massive 16.5%. And on the day, we saw swings of up to down negative 25%. And even though they beat expectations and they even guided to 25% gross merchandise value, GMV, which is well used in the e-commerce industry, higher than estimates. But this particular statement was what spooked the market. For 2026, this is from the CEO, we aim to grow Shopee's annual GMV by around 25% year on year, with its full year adjusted EBITDA no lower than that of 2025 in absolute dollar terms. This was the exact statement that caused the sell down, because this basically means zero earnings growth. And if their GMV is growing and their earnings is not growing, what does it mean? It means they are forecasting increase in cost. They didn't say explicitly, but it's implied from this one statement. And margins will be lower as a percentage of GMV. Since GMV is going to increase and EBITDA is going to maintain the same, margin is going to be lower. And the markets don't like this, right? Because what did I share earlier is all about profitability now. Can they improve their profitability? Can they improve the margin over the next few quarters? And this is also coming from the backdrop of fierce competition from TikTok Shop, as well as Mercado Libre in South America, where Shopee is expanding to. And this is also regions where they have to spend more to capture more market share. As we know in e-commerce, right, it is a matter of who is grabbing the most customer, right? And that is what Shopee is doing now, sacrificing short-term profitability for long-term growth. But the markets are always short-term looking, and that is what spooked the market, which caused Sea Limited to sell down what we saw today. Now, in summary, what we seeing now, right? The market has definitely shifted to a risk-off stance, right? The geopolitical tension is the headlines, but the earnings of what we saw, not just today, but over the past few weeks, it tells us a story of margin preservation and profitability over growth, right? Cash flow is king right now. And even from your portfolio, right? You want to make sure not to be at a state where you want to be super, super aggressive, and you also want to protect your cash flow, right? And we got to watch how the US-Iran tension evolves over the next few days. And if we do see it prolonging even further, or any news that it might last longer and which cause oil prices to spike further, we could potentially see another leg down. So stay disciplined, watch your levels, and don't change the volatility. And that's all that I have for you for today's video. If you enjoy such content, be sure to hit that like and subscribe button because it will really help me to create more of such content for you. Thank you, and I'll see you in the next video.